Can you imagine a service where they tell you the exact moment when the best traders in the market buy and sell? How much do you think that service should cost? You will be surprised because that service exists and it is totally free. It is called volume. Expert traders hate volume because it plays against them. When they invest big amounts, volume immediately reveals them with a large bar like this one. And if you have the proper knowledge, you can take advantage of that information, and that is what we are going to show you in this video. There are two types of investors: small investors who follow the trends and normally win or lose a little bit, and there are big investors that move the prices because they have more money than anyone. They manipulate the markets so they can have true fortunes. When we see a low volume, it means we are watching how small investors invest. But if we see volumes that stand out, those are important for big investors, and those are the ones that interest us the most. When we detect an increase in volume, we must see where the price is going. In this way, we will know that someone big is entering the market and that in this case, his intention is bullish. The basis of markets is pretty simple. A big investment with the power of manipulation makes a strong movement upwards, making a great buy. We can see it because of the great volume that has left us. When the rest of the investors see a big price hike, they rush to buy. We can see that because now the volume is lower. When the price has gone up enough, is where the big investor exits the market again. We can detect this because of the high volume. Since the big investor has sold, the price has started to fall. When small investors see this negative scenario, they begin to liquidate their operations. The price goes into even more panic, and it is here where lots of small investors end up losing their money. The big investor has achieved his goal. It created an uptrend. He expects small investors to go for it because of their greed to make money. In this way, they make the price go up, while they liquidate their investment with millionaire benefits. We have been able to interpret this history by only using price and volume. This is the simple way in which markets work, cycle after cycle. For us to dominate volume, we just need to know these two things. Instead of calling it volume of transactions, we are going to call it volume of interest. When volume is high, it means there is a strong interest in what is happening in the market, and when volume is low, it means there are not interest. Seeing that volume is high when price goes up, and that volume is low when the price goes down, we can intuit that it is more interest in the price to continue going up. For example, if we have an uptrend, our big doubt is if that trend will end or if it will continue growing. For us to know that, we just need to see the volume. When the price has risen, volume is high, showing big interest. However, when the price has gone down, volume was also low, showing no interest. If we see that there is more interest when the price goes up and no interest when the price goes down, that gives us a big clue. This means that big investors/traders want the prices to go up. But if in other scenario, we see that the price goes up, but volume is low, showing us little interest in rise, but when the price goes down there is a big interest, we can see that big traders are manipulating the price down. Thanks to volume, we can know when the price just makes a regression or a change in trend. For example, in an uptrend, we can see volume when the price falls. If volume is low, it shows us a little bit of interest in that the price goes down. We can anticipate that it is just a regression and that the trend will run its upward course. But if on a downtrend, we see that when the prices go up there is a high volume, we can see that it is probable that a change in trend is close. This due to big investors went from support the bearish movement to support the bullish movement. Now, let's see this with real graphics. Here we can see a bullish movement and we also have another bearish movement with a higher volume. At this point, volume makes us understand that there is bearish interest. We see another attempt at price rise, but volume is low. But when we see a bearish movement, again, we see a great volume. We have a small bullish movement, and we see a small volume. There is not interest in the price going up, and we also see another bearish movement again, with a great volume. Now, the price comes and makes a bullish movement and volume does not decrease, stays about the same as the volume of the bearish movement. Here we can realize that it is probable that bearish movement is about to end. Again, we see the price falling and after that we see it going up. We can see that the rise volume is higher than the downstream volume. Here we can suspect about a change of interest. We see again that a low volume turn down means that the big investors have lost total interest in the price to continue falling, and again, when the price goes up, it shows a big volume revealing a big interest in the price to continue going up. Maybe now it is a little difficult for you to see when the volume goes up or down, but give yourself a little bit of time to practice, then you'll see it without any effort. We can also see if there is interest or no interest in breaking a support or resistance. For example, here we have resistance, and when the price goes back to the resistance, we can notice that the volume has gone down. That confirms us that the big investors are not interested in breaking the resistance. It happens the same with the supports. Here we have a support, and when the price was falling, we had a high volume showing us interest in the price to continue falling. However, when the price has reached the support, the volume has fallen once again, showing that there is no interest in breaking the support. And this gives us a clue: it is probable that a bullish movement is created. But what happens if the small investors want to break a support or resistance, but the big traders do not? Let's see an example. Here we have a resistance in the price with a few volume. It is trying to break that resistance, and in the next candle we see a big volume showing, and then the price falls strongly. In this situation, we can interpret that the market wanted to break the resistance and a big trader had to intervene to move the price away from it. What we must interpret here is that there is a big interest that the resistance is not broken. If a big trader wants the price to go up, there are high possibilities of the price to go down. Volume is completely complementary with any strategy or technical analysis. Thanks to volume, we can check if there is interest on an entry or not. For example, if we invest in triangles, we can see that while the price is bouncing inside a triangle, volume keeps low. However, when the price breaks the triangle, volume has increased. That means that there is interest that the triangle has been broken, and it is less probable to be a fake broken. We can also see that the price starts testing the zone again. However, volume is low. That gives us a clue that there is no interest in the price to continue going up. It happens the same when a support is broken. If we see the volume, we can see that it is high, and that gives us a clue that there is interest in the support to be broken, and even when the price goes back again to the support, we can see that volume is low, showing no interest in the price to continue going up. That would be a good opportunity to enter downside. Also, if we have a rank, we know that sometime that rank will be broken. But we are worried about fake breakouts. For example, we can see that the price breaks the zone, but it does that with a little volume. That means that there is not interest in that breakout. That gives us a clue that it could be a fake breakout. However, when the price breaks the zone again, and this time it shows a high volume, that means that there is interest in that breakout. And if the price goes back to the zone again with a little of volume, that shows us again that there is not interest in the price going up, and we can intuit that the price will continue going down. We can go further in our analysis and compare some volumes with others. For example, we see that there is interest in the price to go up, and there is not interest in that the price goes down. The price creates a higher peak than the first one, also with a high volume. But we can see that the second volume is lower. We can realize that there is not interest in the price to go up, that the price turns back, leaving us a double roof. We can draw a zone and wait a break to the downside with volume to confirm the change in the trend. If the price goes back to the zone, we can see if it has interest in entering to the zone again or not. If the volume is low, it is probable that the price will fall. That is called divergence. When the price is increasing but volume shows us no interest in that rise. When there is a divergence between the price and volume, and there are high possibilities of the price to fall, if you do not have a defined strategy yet, you should try to operate only with divergences, since they give an excellent result and they are easy to use once you know how to use them. For example, we see a peak, and when the second one is created, we see that a volume is much lower. That means that the peaks of the price are higher, but the peaks of the volume are lower. There is a clear divergence. That means that the price is overrated and that there are high possibilities that the price corrects itself and go down. As you can see, volume is a simple and powerful tool, and the best way to understand it is to imagine who is participating in the market and try to always be on the side of the big investor. I hope this video will help you to improve your trading results. Don't forget to subscribe to my channel and like this video. See you in the next wave.